So my big idea is, and it's not a silver bullet, it's just my idea, is that we need help to help cities manage their information better, their demographic information and other types of information, because when they get that wrong, so much other is impacted from there. So when we worked at the city of Miami, comparing our drill down data to the city of Miami's data, their census data, the census estimated that the population in 2000 was 367,000 people. When we completed our drill down, we found 504,000 people. We subsequently been able to work with the census to increase their population, so the census now recognizes 480,000 people. But that difference between 504 and 360 is tremendous. And if there's something that you can do right away, this is a census year. In fact, next month the census forms go out, and we have a big problem in the United States. We're working with the city of Los Angeles right now to try to correct for 450,000 miskeyed addresses. In Louisville, the census accidentally dropped 30,000 addresses that they won't have time to add back before the enumeration starts. And so all around the country, this is going to have huge ramifications for the distribution of federal dollars to the distribution of private dollars as well. In our own work, we've worked in 20 cities. We found 1.5 million more people than the census has captured. We have found $36 billion of missed economic income. And we worked with 8 cities to actually, it's 320,000 people, 320,000 people to have them added back to their population. 85,000 last month in Philadelphia, 80,000 in Dade County, 48,000 here, 50,000 in New Orleans, 35,000 in San Francisco, etc. For every person missed by the census, the U.S. Conference of Mayors estimates that city loses $2,200 per person. The University of Massachusetts estimates that number may have risen up to $3,200 per person based on the new stimulus dollars. So when you talk about adding back 300,000 people, you're in the range of $700 million. That's a tremendous amount of money that's being misallocated across 170 federal programs, $400 billion a year, going to suburbs are being overcounted today, and urban areas are being undercounted. So the first thing you can do is engage your local government in their complete count committees and make sure that you're participating in trying to get the best census count as possible. By the way, in the Miami study, in African-American neighborhoods, the undercount was 95%. So our theory of change is that lack of information, then markets, and I like to associate myself with ICIC because they've really done a tremendous amount of work that's been, allowed us to have area cleared for us to come back in behind them and to fill in some of the dots. But you have to have the information. That the lack of information creates the high cost of data. The high cost of data leads to the misperceptions of communities. Therefore, you have a cycle of decline. And this is our theory of change. And while this is a longer-term view, helping cities manage their census and their demographic data on the front end can go a long way to helping correct some of this. What we do with this data afterwards is, and I'm just going to go through a series of tools and I'll stop there, is that what our capacity, our competency is managing point-level, parcel-level data. Whether it's mortgage records in Detroit, credit card records in New York City, demographic data in a host of cities, it's managing point-level data. And we do that to correct for the misperceptions, but also to show where the opportunity in the market is. So in the city of Detroit, working through the Ford Foundation and Kresge, we were able to map everyone's mortgage data real time. There's a 3-week lag between the time we access the data and when we can map it. But we know where people who are 30 days delinquent in their mortgage. We know who the resets are. We know the short sales and that sort of thing. And that's important so that we can begin to build pricing models so understand what the clustering effect of a home is when the house next door goes from market to foreclosure. Because we know that in Detroit, we've lost $5 billion of value in the housing market. But how has that been distributed? And so what you're looking at now is this hedonic pricing model that shows the value of homes in clusters based on where they are in proximity to other clusters of homes. And then the blue circles in the middle where homes are going through a mortgage foreclosure counseling. So the counselors have some access to information to try to get, it's not objective by any standard, but a more objective understanding of what the market is. And what it's also allowed us to do is correct for the misperception in Detroit. If you will go to the Case-Shiller Index, they will attest that the Detroit housing market has declined by 48 to 50%. But what they don't do is they don't disaggregate market transactions from distressed transactions. When you take out the REO sales and the other distressed transactions from the market transactions over the last 3 years, the Detroit market has only declined 14% for those transactions that have occurred in an arm's length market transaction. That's a very small decline compared to what the rest of the world is looking at Detroit right now. Now, the REO market has absolutely fallen through the roof, no doubt. It's declined 95%. You can get homes in Detroit $8,000 to $9,000. but the tax liens are perverting that market, so we don't know what that true value is. We also are creating composite indicators for the GSEs and other national banks where we can take, Miami, we can look, what census block is predominantly African American, what census block is predominantly renter, average household income, median home values, and create a psychographic model. Who's most likely to want to be a first-time home buyer in the next 12 months? So that we can then bring a market back into Liberty City or to Little Haiti, as well as the mortgage insurers and the title insurers and whatnot. And this work in Miami, it's actually allowed the credit policies of the National Bank to begin to reevaluate where they're putting premiums on mortgages. It's allowed the risk profiles that go under, that are the foundation underneath title insurance and mortgage insurance to be calculated so the title insurance is decreasing in cost. In a place where if you don't have 20% down, it's a tough place to get a mortgage. We're trying to do this with food security and retail. So in Cincinnati, what happens when you map leakage or that amount of that money is being spent outside the neighborhood, but also overlay that with mispopulation and rates of obesity? Where is that one intersection where that grocery store is most likely to be successful, but it can be tied to a public policy rationale? Taking small businesses in Washington, D.C. to create lots of indicators around small business development, number of jobs created by business, the growth of that business, the history of that business, so that over time, when we get back to Miami, you can create a trade area for our beauty salon. That's something that can be underwritten by a small business loan. And so it's creating a business intelligence platform that are allowing decision makers to understand what is happening in that market, because right now we don't. And when we have that lack of information, it becomes a capital barrier to investment. And then the last two are looking at credit card usage in Greenpoint, Williamsburg, and D.C. And New York or Brooklyn. What percent of people are using American Express versus Visa, MasterCard? How often are they using those transactions at a household level? What is their equity line in those households? So that we can begin to understand how cash flow is moving. Because we did understand once we got back down to this level is that Hasidic Williamsburg is much different than Latino Williamsburg, and Polish Greenpoint is much different than the artistic community in Greenpoint. But we have to treat these neighborhoods very localized. And then finally, how do people live their lives? So tracking credit card transactions, focus grouping, people who think that they buy locally, people who think they shop in their own neighborhood, to actually map how far out they're going to get their goods and services. They're surprised, because if you ask them on a weekly basis, I'm getting everything I need in my neighborhood. But the fact of the matter is they're traveling across the 3 state areas. This is Washington, D.C., and then grocery is particularly acute. They're traveling 2 to 3 miles further than they thought they were traveling. So again, this is just an opportunity to create a business platform so we can create some of the, correct for some of the information asymmetries in private investment. And what I hope if we do get the opportunity dividend, what we're going to be investing in is rationalizing the zoning code, putting form-based content and inclusionary zoning in, investing in all the things we talked about, but reducing the transaction costs that people incur when they make private investments. At the end of the day, that's what gets to the ROI, the ROE that someone needs to understand. And we can't get to that number, then all the investment won't happen. And when someone made it earlier, we're not going to stimulate our way out of this problem. We need to attract private investment, and we need to have the tools and the toolkits that allow us to attract private investment. Thank you.